Hello, and let's take a look at the macroeconomic indicators driving investments and valuations as it stands in Q1 2025. Let's take a look at the headlines that we saw coming out today and in the recent past. The the thing that's captivated the headlines is Trump's confirmation of tariffs. The markets plunged today largely because of that. Consumer spending has shown to be falling, and US economic growth slowed compared to previous forecasts in Q4. So, what does all of this mean for the outlook for investments and valuations in 2025? The key macroeconomic in this presentation, I'm going to outline the key macroeconomic numbers that we follow closely as they give us signals as to where investment flow and valuations in the tech sector, especially enterprise AI, are going to be driven in the coming months. The factors that we look at that drive what drives investments, money flow, and the expectation of future growth on uh, on the economy and the GDP. What drives GDP? Consumer spending, government spending, and net imports. And you can see the administration is working, impacting the policies, and the uncertainty of the administration's future policies is going to drive those factors. What drives the money flow? The money flow is driven by the interest rates. What drives interest rates? It's the Fed funds rate, and what drives the Fed funds rate is how well the inflation is trending towards 2% and how well the economy is up to a full employment level. And what's full employment? Means everyone who's looking for a job is able to get a job. So in this presentation, we'll dissect these macroeconomic factors that then drive the amount of capital flowing in, that then drive also the kind of valuations that we can expect to receive. Here are the key highlights. The data we got in Feb, most recently last week, Friday, was that the core PCE went down from 2.9 to 2.6%. Now, while at the high level, that sounds very encouraging, when you look through the peel through the onion, it's not much because it's largely because 1 month, January 24 was high. The number continues to remain a little bit concerning, but nothing very alarming. Consumer spending was reported to be moderated. Remember, GDP is the sum of government spending plus consumer spending plus net imports. Consumer spending slowed down, which means GDP slowed down. However, the disposable income was high, which means the savings went up, which means the future investments, which also contribute, the net investments also contribute to the GDP, will be on the positive. Total employment number remains strong. The CPI headline inflation remains a little bit high, but nothing to panic about. Valuations continue to steadily climb in the tech sector, except this recent past with the new administration taking over. There's always a little bit wait and see and uncertainty that comes in. Most of that clears out by March, April onwards. Many of the key policies start taking effect, and there's stability and visibility of what's going to happen. And so I expect that to start smoothing back up again in Q2. And let's take a look at the employment. Overall, the employment numbers look very healthy. For all these factors, and we'll get into detail in the presentation, we see no clear reason that would drive as of today. Now, that could change between now and mid-March when the next Fed funds rate will come out. And the short-term uncertainty is largely being driven by policy uncertainty, and that is going to continue to push out business investments until the dust settles. My name is Sunil Grover, and I'm the managing partner of True Blue Partners. At True Blue Partners, we are focused on helping entrepreneurs build the next generation of enterprise AI companies by providing them investments, helping them find that initial product market fit, and helping them get subsequent financing so they can continue to fuel the growth. So, to get a sense of how the market is going to look like for subsequent financing, we also look at these macroeconomic factors and indicators that influence future financing. That's what this presentation is largely gonna cover. Let's take a look at the headline CPI number. Now, this chart goes back to January of 22. You'd remember inflation was fairly high, started moderating, and has been quite steady in that 3% to, well, 3% last reported in January. Now, this is the headline number. It has a lot of, variability because of food and energy prices being highly commodity items, and the adjustments in those are almost instantaneous in the grand scheme of things, them being commodities. And it's been a fairly stable headline CPI inflation number. When we peel through in January, last 12 months was 3%, but month over month, the core was 0.5, which, analyzed is a very high number. We look at that as well. But overall, inflation is bouncing up and down around 3%. It's not quite trending towards the 2% that everyone likes to see. However, superimposing that with the Nasdaq, you can see after having a downward slow trend up until early 23, Nasdaq has been on a steady climb until recently, which, as you can see in the broader scheme of things, is noise, largely because of the new administration coming in and getting their policies all settled in. Month over month change in headline inflation numbers. You can see this trend in November, December, January. Numbers are increasing. What's driving the increase? Fuel, oil prices. So commodities, are usually the drivers of these month-to-month inflation numbers. They don't necessarily give a measure of the health of the economy, and so the Federal Reserve, and therefore we overlook those. This is the key number that came out on Friday, the core PCE, personal consumption expenditure. Prices go up, consumer spending goes down, consumers start moving the spending to cheaper items, and PCE captures the total dollars spent as an index, and it kind of neutralizes the fact that when the prices go up, demand goes down. And you can see that the PCE, which is a precursor to the driver for inflation, has been trending down all through 23, through mid 24. And after mid 24, as we started entering the election cycle, there's been pretty much flattening out. This could be regarded as noise. This went down, but January of 24 had gone up quite a bit. So last 12 months, indication is it's not a trend, but it's just bouncing around in that 2.7, 2.6. We want this to be closer to 2%, for the Federal Reserve to get some comfort that the inflationary pressures have totally been weeded out. This slide talks about the current monetary environment, and actuals versus the revised forecasts. And it gives you the Fed's fund rate. So the forecasted Fed funds rate, even though we're at 4.1, I think the Fed signaled that they would not be lowering it further somewhere in December. We don't see a reason why they get lowered any further in March either. This chart has a combination of these three factors kind of playing together, and it's quite frankly the stuff that we care most about, which is valuations in software as a service. We have this proprietary SaaS index as a revenue multiple that we track. Here's your Nasdaq index. Here's the Fed funds rate. So you can see as the Fed's fund rates started growing, the valuations started declining, and the valuations, which is the multiple, the revenue multiples, have been steadily pretty much flat, maybe moving up a little bit up until September 2024, where there was signaling that the interest rates are going to start coming down, and you see the valuation multiples increasing. So the question is, where do we go from here? And what we know is that the interest rates are not going to come down in March. Maybe they'll come down in the next reading. Depends on what happens between now and then. So we don't see the valuation multiples increasing much between now and until we get better signs of the interest rates coming down. meaning better signs that the inflation is coming down. This line here showcases the revenue multiple for all of Nasdaq, and that's a combination of interest rates as well as expectation of growth rates. If the GDP goes up, the investments in technology go up, and therefore the Nasdaq, which is representative most of the tech stocks, and our focus more being on enterprise AI and the SaaS stocks are driven by the sentiment of making investments in boosting productivity. So we also look. Let's take a quick look at the unemployment rate, because that's something that the Fed's going to look at very carefully. We look at three key data points: the unemployment rate, the quit rate, largely driving people who are looking for jobs are able to find jobs. Is the quit rate going up, meaning the economy might start heating up? Quit rates going down means the economy is not heating up, which is means the inflationary pressure is a little bit lower. And employment population ratio indicating everyone who's looking for a job is able to find jobs, and as a function of the overall population, those numbers look very healthy. Total labor market, how many people are working, that number is pretty high, almost at an all-time high as compared to the recent history. 164 million people are employed by the economy. So nothing here indicating that the economy is going to slow down. Labor productivity, continues to go up. I think I don't believe this is seeing the impact of AI just yet. A lot of the enterprises are just in that very early stages of trying to figure out how to use artificial intelligence technologies to boost productivities. Most of the investments have gone with the hyperscalers and the NVIDIA chip makers. Still to percolate through in improving productivity is our general sense. But overall productivity is now on an upward trend. This, as you can recollect, was related to COVID. COVID started in 2020, and the reopening started shortly thereafter. So what to watch in the coming months? Inflation, core PCE seems to indicate that the Fed funds rate will remain unchanged in March, but anything could change between now and then. We don't think so. Obviously, the Trump economic policies are going to keep driving uncertainty in the short term. Key things that are getting impacted, again, what drives growth rates is growth in GDP and the people anticipating growth in GDP. While everyone is optimistic, all investments, as far as we are hearing in our conversations with various CEOs and CFOs, they want to wait and see how the trade and tariffs and the settlement of the kind of uncertainty, global uncertainty, finding out policy and policy strategies. But overall, it's expected that trade and tariffs will go up. National debt and inflation continues to be a item that will be closely monitored, and there should be some more deregulation, but this is still in that uncertain phase. I think Q2 onwards, as it becomes clear what policies are getting into effect, this will stabilize, and the confidence of businesses to make investments is going to increase. Well, we had a pretty dramatic Friday and a weekend on the whole Ukraine-Russia war and peace treaty. How that impacts valuation and investments is really the oil prices and the oil flow into the global markets. Oil is still a little bit high. There is room for that to decrease, and that can have an impact on the headline CPI inflation numbers. But as we saw in the analysis, that does not impact the investments and valuations as much. It might have a positive net impact on consumer sentiment, which is always welcome. But all said and done, Fed Reserve has a lot of firepower. So it's just a matter of the new administration's policy and policy stance becoming clear. Therefore, releasing some of the investment dollars from various businesses that are slated to go into effect. There's a little bit of uncertainty. People are pushing things out. But overall, we see a lot of positive trends and positive drivers for a good year of investments and valuation upswings. Uh, Thank you very much. If you'd like to get a copy of the presentation, there should be a link below. And look forward to continuing the conversation.